You're not losing because your strategy is bad. You're losing because you're entering at liquidity levels that aren't valid for reversals. This video will cover buy-side and sell-side liquidity, with a primary focus on old highs and old lows, as well as equal highs and equal lows. So let's get straight to the charts. Before we get into anything else, the first thing we need to understand is swing points in the market, because this is how we identify where liquidity is resting. Over here we have a swing low. So how do we know this is a swing low? We have a low formed here, with a higher low on the left and a higher low on the right. That structure confirms this point as a swing low. Similarly, over here we have a swing high. We can identify it because there is a high, with a lower high on the left and a lower high on the right, which makes this a valid swing high. Now, to understand why swing points are important, we need to think about the psychology of traders. If someone enters a long position around this area, they are most likely going to place their stop loss below the swing low. And in the same way, if someone enters a short position around this area, they are most likely going to place their stop loss above the swing high. With that understanding, we know that there are sell stops resting below these lows and buy stops resting above these highs. The sell stops below these lows are referred to as sell-side liquidity, and the buy stops above these highs are referred to as buy-side liquidity. Smart money looks to execute and pair orders below swing lows and above swing highs, where that liquidity is resting. So now that we understand this, let's move over to the charts and look at some real examples. Now we're going to practice identifying swing points along with buy-side and sell-side liquidity. Looking at this 4-hour chart, where are the obvious highs and lows? Right here we have a low. This would be considered sell-side liquidity because we have a low with a higher low on the left and a higher low on the right. We also have a high right here. This would be buy-side liquidity since there is a high with lower highs on both sides. Now, if you look closely, notice what price just formed. We put in another swing point, again, a high with lower highs on each side, so this also qualifies as buy-side liquidity. As we move forward, you can see there are also external buy-side and sell-side swing points, but let's keep progressing with price. Here, price takes this low. Now what do we have? We have a new swing low because price has formed higher lows on both sides of this point. Moving forward again, we get another swing low here. You can see higher lows on both sides of this low as well. However, price fails to take this high, which makes this level an equal relevant high, and this also acts as a liquidity point. Continuing forward, we now have another swing high right here. Why? Because on both sides of this high, we have lower highs. Next, price sweeps the low that we previously marked. After that sweep, a new swing low forms at this point. Moving forward again, we have this swing high here, but price continues from it, which doesn't change our process. And finally, you can see price taking out all of the swing highs that we marked. This is how you identify and mark swing highs and swing lows on your charts. The time frame doesn't matter. You just need to be familiar and comfortable with the time frame you're using. These swing highs and swing lows work the exact same way on any time frame. The next thing we're going to look at are two important types of liquidity. These are old highs and old lows, and relatively equal highs and lows. I already have these marked out on the chart from the previous example, so let's break down what they actually mean. First, let's talk about relatively equal highs and lows. This can show up in a few different ways. One common example is when you have two separate swing points that are very close to each other in price. Even though they're not exactly the same level, they're close enough to be considered relatively equal highs or relatively equal lows. Another way this appears is when you see multiple highs clustered together around the same area. When price keeps reacting around the same level like this, it forms a clear pool of liquidity. In that case, those highs are considered relatively equal highs. The same concept applies to the downside as well. When multiple lows form near the same price level, those become relatively equal lows, and liquidity tends to build up around them. Now, the other type of liquidity we need to understand is old highs and old lows. Old highs and old lows simply refer to a previous swing high or swing low that clearly stands out on the chart. These are levels where price previously turned or reacted strongly, making them obvious reference points for traders. Because these levels are so visible, many traders place their stops around them, which is why they often act as liquidity targets for price. So whether it's a cluster of equal highs and lows, or a single old high or old low, the idea is the same. These areas tend to hold liquidity, and price is often drawn back to them. Understanding these two types of liquidity helps us anticipate where price is likely to move next, instead of reacting late after the move has already happened. The next thing we're going to talk about are liquidity levels that I always have marked on my chart, or at the very least, I always know exactly where they're located. The first liquidity level I always mark is the previous week's high and previous week's low. The reason I do this is because these levels act as very clean and obvious liquidity draws. Price is naturally attracted to them, and they can also be used to frame potential reversals. Because of how visible they are, a lot of traders reference these levels, which makes them important from a liquidity standpoint. This is something I always have marked on my chart, no matter what market or time frame I'm trading. The last major liquidity levels I consistently pay attention to are session highs and session lows. In this example, I have the Asia session high and low marked, along with the London session high and low. Session highs and lows are extremely useful because they help us build a narrative. They can act as a draw on price, or they can help us frame a reversal depending on how price reacts around them. Now let's take a look at some examples and see how session highs and lows can actually play out in real market conditions. If you notice here, we also have another important liquidity level that I always mark: the previous day's high and previous day's low. Just like the weekly levels, these daily highs and lows can either act as a target for price or be used to anticipate a reversal, depending on the context and the structure around them. So whether it's weekly highs and lows, daily highs and lows, or session highs and lows, these are all key liquidity areas that price consistently reacts to, and that's why they're always part of my charting process. Let's walk through a real example and see how session highs and lows can actually play out in the market. If you look here, you'll notice that the Asia session low has already been taken. However, above current price, we still have the Asia session high untouched. On top of that, we also have relatively equal highs forming around the Asia session high, and both the London session high and London session low have not yet been reached. So going into the New York Open, we already have a clear liquidity narrative. As New York opens, we see price push higher and take the London session high. Now, from this point, what can we do? We can start looking for short opportunities, with targets set at the London session lows. For entry confirmation, what do we see? We get our first change in state of delivery, and shortly after that, we get our short entries. From there, price moves directly into our targets at the lows, and you can see how cleanly the market delivers into that liquidity. Now that the London session lows have been swept, what can we reasonably expect next? We can expect a bullish reaction. So now we shift our mindset and start looking for long opportunities. If we look for entry confirmation here, we do see an inverse and a change in state of delivery. However, we don't take the entry at this point because price does not show displacement above the inverse, which is a requirement for us. So instead of forcing a trade, we wait. Price then gives us another manipulation lower. After that manipulation, we finally get a clean inverse with strong displacement. Now we have confirmation. At this point, we can enter long and target the equal highs above, which are resting near the Asia session highs. And as you can see, price moves smoothly into those targets. This is exactly how session highs and lows help frame my trading decisions. They give me clear liquidity targets, structure, and confirmation instead of guessing entries. So this is how you're going to use all of the liquidity points we talked about earlier in this video, whether it's swing highs and lows, old highs and old lows, equal highs and lows, previous day or previous week highs and lows, or session highs and lows. The process is always the same. You identify where liquidity is resting, You wait for price to interact with those levels, and then you look for confirmation before entering. You're not predicting. You're reacting to what price is showing you. These liquidity levels by themselves are not entries. They're simply areas of interest that help you build a narrative and understand where price is likely to move next using ICT concepts. When you combine these liquidity points with structure, changes in state of delivery, and proper risk management, your trading becomes much more consistent. If this video helped you out, make sure to like the video. It really helps support the channel. If you want more ICT-based breakdowns like this, hit the subscribe button. If you want to connect with me, you can join my Telegram and Discord. The links are in the description below. And if you want to learn personally from me, you can check out the mentorship link in the description. I've also left discount codes for funded accounts in the description if that's something you're interested in. Trade safe, manage your risk, and I'll see you guys in the next one.